Hi, I'm Roger Montgomery and welcome to this week's Video Insight. I mentioned last week the three factors that could prove to be drivers of a stock market boom. First, negative real rates of return in cash. Second, baby boomers desperate to earn more than the breadline. And three, a disproportionately large amount of cash thanks to the GFC, and that cash being held by baby boomers who are desperate to earn the income. The result, of course, is a generational tidal wave into riskier assets. But it could be a boom that flies under the radar. In fact, since last week's vlog, the S&P 500 is up 2.5%, and there's been really no recognition of this. Perhaps under our scenario, the market simply grinds higher, and we look back after 12 months and find ourselves surprised by the gains. Of course, there's always the risk that we're wrong, so don't follow everything that we do. And I note that cash has been building fast over at Berkshire Hathaway. With a record $50 billion sitting in cash now, you might draw the conclusion that Buffett is bearish. But of course, he does find it hard to find things to buy and spend the money faster than it flows in. With all those businesses, the cash is flowing in much faster than he can spend it. Reporting season in Australia is a little over a quarter of the way through, and I reckon the theme has been companies feeding the insatiable dividend demands of baby boomers. Where dividend surprises and buybacks have been announced, the response has been positive. I'll give you some examples. The market has responded positively to dividend surprises and buybacks from Suncorp, which of course paid a special dividend, Telstra, which increased its dividend and announced an off-market buyback, and CSL, which also, as I'll mention in a moment, announced the possibility of a new $950 million buyback. Generally, so far, the big caps, the top 50 companies, have been pretty well supported, as have the very smallest companies. But keep in mind, of course, companies with nothing to hide tend to be more organised, and they tend to report earlier in reporting season. And I'll make the observation that share reactions seem to be overdone to the good news, or the less than bad news. And where that's occurred, I think it's correlated to heavy short selling interest and better than feared results. So some examples: Cochlear, Mineral Resources, Fairfax and Bradken. Mid-sized companies, however, I reckon have been a bit disappointing. Those that rank between 50 and 100 by market capitalisation, in other words the 50 to 100 segment, have generally not impressed. In terms of the best results so far, CSL, one of our largest holdings, and Crown Limited, one of James Packer's largest holdings, as well as Genworth and Rio, have all reported fantastic results. In the case of CSL, those low interest rates that I mentioned a moment ago are having another positive impact for investors. Those low interest rates have caused the world's second largest blood therapy biopharma company to consider another $950 million share buyback. And CSL also beat its own guidance, lifting its full year profit by 8% to $1.3 billion with CEO Paul Perreault forecasting another profit growth of 12% for 14-15 financial year, and earnings before interest and tax, or EBIT, growth of about 15%. This is fantastic for such a big company. Now, Mr. Perreault said that another buyback program similar to its nearly completed $950 million program already in place will be considered, and I suspect it'll go ahead, with low interest rates and cheaper financing part of the motivation. At the other end of the spectrum are results from companies like JB Hi-Fi, James Hardie and Leighton Holdings. You might be aware, of course, that we sold JB some time ago, and after the departure of the CEO and the lowering of incentive hurdles caused us to review our growth assumptions for that company. Elsewhere, QBE, AGL Energy issued warnings, and the average company is likely to grow by less than 7.5%. According to one analyst whose work we really like, the average upgrade to 2014 estimates is only about 1%. In the background, all the noise about higher interest rates is premature. As I said to you last week, we expect Janet Yellen in the US and Glenn Stevens here at the RBA to keep rates lower for longer. This will fuel the continued migration of a disproportionately large amount of cash into riskier assets. That means shares and property. With the Aussie dollar at levels rendering Australia uncompetitive, and we talked about that last year, Glenn Stevens will want to see the US go first on a rate rise, and Yellen is in no rush to repeat the mistakes of 1936 when rates were raised too early and the US plunged into a double-dip depression. So for now, the music will keep playing and the party is in full swing. Those of you who are nervous are right, however, to dance close to the door. At some stage, the music will stop, but of course, you won't want to wait until then because there'll be no cabs to take you safely home. As value investors, we know we're going to be early to exit, but for now, we're eagerly seeking any opportunities we can find to be weighted towards great businesses generating returns much, much better than what we can get in cash. That's all for this week. We'll see you again next week, and be sure to follow us on Facebook and Twitter.